Hi. Hi, everyone. Welcome to another episode of Zerodha webinars. We are happy to introduce Bob Baur, Executive Director and Chief Global Economist for Principal Global Investors. In these capacities, he establishes and directs global economic policy and strategy. He oversees and conducts macroeconomic and quantitative research, forecasts economic trends, anticipates market movements, and advises the investment staff in making economically sound investment decisions. Bob received a PhD in economics and a bachelor's degree in mathematics from the Iowa State University. He also completed postdoctoral study in finance and economics at the University of Minnesota. About the company Principal, Principal was founded in 1879, which is a diversified financial services group which manages more than $667 billion of assets. It's a Fortune 500 company that offers solutions across fixed income, equities, real estate, mutual funds, ETFs, alternatives, and structured investment strategies. Bob, it's such an honor to have you here with us. Please do take us through your thoughts about the Indian and global macro situation and how our investors should position themselves given the present circumstances in the market.
Great. Thank you very much for that kind introduction. I'm delighted to be with you all this afternoon. It's a real pleasure for me to be here, and I'm very happy to share with you some thoughts about U.S. elections and global and Indian markets and economy. Why don't I start first with the U.S. election, which happened last Tuesday, and talk a little about that. And then I'll have 3 points I want to make about the global economy. The U.S. election happened last week, and the question is, what happened? Well, I guess the real answer is not too much. As you probably know, the U.S. Congress is composed of two different parts. There are 100 senators and 435 representatives called the House of Representatives. Now, prior to the election, the Republicans had control of 51 of those 100 seats. Right now, the control is 52. And one Senate seat still undecided, so the Republicans could have 53. In the House of Representatives, the Republicans did have a small majority of control. I think they had about 228 representatives before the election, and after the election, now the Democrats control the House by about the same kind of slim majority. So what does this mean for the future of the politics in the United States? Well, not a whole lot. Some of the key things that the Trump administration was looking at or doing was deregulation, trying to keep large, expensive regulations out of business. That's still going to go on. Another thing they were doing, and what was part of their priorities, was appointing conservative justices to both appellate courts and the Supreme Court. That is going to continue because now the Republicans have a little more control of the Senate. And last, key thing is international relations. That would be that trade confrontation with China is definitely going to continue. Also, international relations, the attempt to gain some relationship with North Korea, for example, those things are all part of administration purview, and that's not going to change. So the confrontation with China will likely continue. Trade issues will also continue. In terms of getting legislation passed with a split Congress, probably not too much is going to happen. The one thing that could be positive for the U.S. economy is an infrastructure bill, because both parties would like to have better roads and better bridges. So that might, something like that might happen. What that would do is continue the strong growth in the United States. So now I'd like to switch to the global economy and how it relates to global financial markets. And I've got a couple of points I'd want to make. Point number one is that I think we're in a vastly different monetary environment than we've been in for a long time. And I think maybe one way to understand that is to think of a little story about two little fishes. Two little fishes, they were, swimming around in the ocean, young, small, having a wonderful time, just playing back and forth. At some point in the day, a great big old daddy fish swims by and looks at the two young fishes and says, "Good morning, boys. How's the water?" Well, one little fish looks at the other little fish and says, "What the heck is water?" Well, now, the point of that story is that sometimes the most obvious and the most important part of the environment, the most ubiquitous part of the environment, is so obvious that few people really understand what it is. And I think that is in part the case for financial markets around the world over the last almost a decade. Because central banks in developed countries and China and other central banks in emerging markets over the last decade, in response to during and after the global financial crisis, it pushed out a huge tsunami of liquidity. Those were central bank created funds that bought bonds. Interest rates were taken to very low levels. In China, the state-owned banks essentially okayed about any kind of project as long as it was semi-reasonable. So all of this liquidity ended up washing over all asset prices, whether they're house prices, commercial real estate prices, stocks and bonds, and really all domiciles. Interest rates were taken down to extreme lows. And in some sense, the huge stock market rally that started in the US in March of 2009 and continued most of the decade up until the last year or so, in some sense, that big rally, the stock market was a kind of extension of monetary policy, because the present value of stocks, as you know, is determined by the future earnings. But then we all know that a dollar in the future is not worth as much as a dollar today. So you have to discount those future earnings. And the lower the interest rates are, the higher is the present value of stocks. But now that huge ocean of liquidity that swamped over all asset prices is beginning to be withdrawn. And as you know, when liquidity is withdrawn, then you start to see some credit problems. We already saw the first casualties a month or two or three ago in Argentina and Turkey. But as that liquidity continues to be withdrawn, I think we'll see more casualties will spread a little broader across not only emerging markets, but the credit stress will extend to high yield stocks in the United States, Europe, probably elsewhere. And I think we'll see continued credit stress in emerging markets as the next group of vulnerable countries comes under stress. I don't think India is going to be one of those emerging markets, but we'll see. It's certainly been impacted by the contagion that we've seen so far. So as this surge of liquidity is ending, and the Federal Reserve in the U.S. is well along in that process, we look for one more rate hike in December, and then we look for another rate hike in March of next year, so long as the stock market continues, if it able to continue flat or continues to rise, we'll see another rate hike in March. But then that would get the Federal Reserve upper range on Fed funds to 2 3/4, which I think is right in the middle of the range of neutral. So I would guess, so long as inflation is not a problem, which we don't expect, that the Fed would stop at that point and at least wait a few months and see how the market is able to adjust at that point. We do look for long-term interest rates to continue to rise here in the U.S. 10-year yields are around 3.2 or a little less. We think they'll rise a little later this year. Along with stocks, we do look for another stock market rally, kind of a Santa Claus rally, yet in November and December. I know the big decline in U.S. stocks last night didn't looks like that's not going to happen. But I think in part that big decline last night was caused by the San Francisco Fed president, new president, Mary Daly, made some really hawkish comments. But we do think we'll see 10-year Treasury yields at 3.5 yet this year, maybe early next year. But I think, however, that will be a really difficult level for the stock market. So, frankly, we're looking for a downdraft in U.S. stocks next year. Those higher interest rates, continued higher wages, a little higher credit stress, I think is going to lead to some earnings disappointments. So that's the first point I wanted to make, that this is a much different economy or monetary policy environment than we've had. Now, the second point I want to make is that there is, and I think there will continue to be, a kind of dichotomy between the real economy and between financial markets. I've just kind of pointed out how I think financial markets will continue to struggle. But if we look at the real economy around the world, the real economy is just doing pretty well. The U.S. economy, for example, is just booming. Capital spending is doing fine. The labor market is really just red hot. Consumer spending has been very strong, 4% consumer spending for the last couple of quarters. So we think we'll see economic growth in the U.S. at 3.5% for several quarters this year, and probably stay near 3% or slightly more for most of next year. I think this probably is true around the world. If we look in Europe, we look for 1.5 to 2% growth in Europe yet this year and mostly next year. If we look in Japan, we look for 1 to 1.5% growth in Japan. Those are a little lower than last year, but they're still slightly above trend. Consumption is good in Europe. Unemployment is coming down, and wage growth is good in both Europe and Japan. Corporate profits and the number of people working just continue to hit records in Japan. China, the second largest economy, is in a little different situation. It's in a gradual slowdown, deceleration of growth. The 30 years of the one-child policy means its labor force is going to shrink. Starting probably this year, next year, or shortly thereafter. In addition, they're trying to slow the growth of debt in China so they don't have a big financial crisis in the next few years. And they're also trying to cut the awful kind of pollution. And none of those three things is positive for China's growth. So I think this. And if you look at India, you've had here in India a couple of quarters of 8% growth or so, and I think that kind of 7% or so growth will probably continue. You've had several things that have kind of been a big drag on growth in India. You've had the demonetization, the change in the sales tax across state lines. You've had the recapitalization of banks, and then lately the problems with one large non-financial bank company. So there have been some drags on growth. But we think with oil prices down, and we think they're probably not going to spike again, and with inflation still under control here in India, and the Reserve Bank not being aggressive on raising interest rates, and your currency, of course, has depreciated, which ought to help be somewhat a help for exports. So we think growth in India is going to continue to be strong. But the financial markets, as I said, we think they're going to struggle, not only in the U.S., but around the world. Now, if we're right that the U.S. stocks may endure a sharp downdraft next year, and I think it could be on the order of 25 to 30%, and that doesn't need to coincide with a U.S. recession. There have been 7 such bear markets in U.S. stocks since 1960, unassociated with a recession, and I think that will continue. So this dichotomy between a reasonably strong global economy and struggling financial markets because of what is happening to this surge of liquidity, that's going to continue. So what should investors do between now and then? Well, I think the third point I would like to make is that the timing is going to be very important next year. Because if you look back, if you were an owner of US stocks, all you had to do was just own an index for the last 7 or 8 years. But I think that's not going to be true as we go into next year. And in fact, when I mentioned struggling financial markets, it's certainly true that US stock markets, while they're the best performing in the world this year, they've really, as of last night, essentially flat. So there are hardly any major US indices been up very much this year. So I think that's going to, I think this is really a time to be cautious. So, but timing is going to be important. If we do get a rally between now and the end of the year and we get interest rates rising in the US, that means that investors ought to be stay with a short maturity fixed income. But then if we do see 10-year treasury yields get to 3.5% on 10-year treasuries, I would extend out your the maturity of your bonds, because I don't think interest rates at that level will stay there very long. I think interest rates will fall off. So where will be a place to hide? I think a couple of suggestions. You know, commodity prices have been under a lot of pressure now for a long time, and outside of oil, copper, for example, iron ore, they're down near several month lows. And frankly, I think some real assets over the next year might be a place to hide, because they've already had a huge decline. Commercial real estate, I think, is also good, because in some sense, commercial real estate in many locations around the world, probably, you know, residential property here in Mumbai has not been a particularly attractive investment. So this is maybe one of the better places in the world to buy housing. I think it's more affordable. But there are other places for commercial real estate, and you know, commercial real estate kind of straddles both the real economy and financial markets. Certainly, interest rates make a difference on property prices, but the income from real estate, commercial real estate, is makes it. It depends on the real economy, and if there's a little bit of inflation, that means rent can rise. So the income from commercial real estate can still be positive. In general, we look for this as a place to invest in some good, solid, high-quality income-producing stocks and bonds. Frankly, we like U.S. 10-year Treasury yields. If the yields get to 3.5 or 3.6, we look for German Bund yields. If they hit 0.8 or 0.9, I think they would be a good investment. Japanese government bonds at a higher yield than today also would be pretty good. Look at real assets. I think that would also be helpful. Now, if we look here in India, I've already mentioned, you know, I think the international environment is probably pretty good for India, for investments in India. There has money certainly flowed out of India over the last year or so. But I think if we do get this downdraft in U.S. stocks, that the dollar is going to peak sometime the end of this year, early next year, and start to decline just a bit. So funds, I think, are going to flow out of the United States as U.S. stocks underperform. So where are those flows going to go? I think in part they'll go into some safe haven assets. But, you know, India in some sense is kind of unique in that with its currency down, with oil prices not going up anymore, with your budget deficit in better shape than it has been, you know, I think it's possible, but not maybe likely, that money is going to flow into India. But frankly, it's my favorite emerging market at the moment. So with those comments, maybe I turn it back to our moderator and see what questions there are.
Thanks, Bob. That was really interesting. We had a good time listening to what you had said. And we have a few questions in place. Some of our viewers have given questions, and some people within the organization have shared some questions for us. So the first question I have for you is, we know that there are, rising trade tensions, and they have been a source of instability in the markets. How do you see this playing out in the mid to long term?
Well, unfortunately, I think those trade tensions, at least between the United States and China, are going to continue. I mentioned the U.S. elections at the beginning, but I think those U.S. elections are not going to affect the issues between the United States and China, because that is bipartisan in the United States. I think both the Democrats and the Republicans agree that China has not necessarily been a fair had fair international trade rules over the last decade or two. So I think that's going to continue. However, trade makes headlines, but it's liquidity that makes markets. And while the headlines about trade issues have been an easy explanation for those volatile markets this year, I frankly think it was my first point that this withdrawal of liquidity has been the real source of that market volatility. In the U.S., there was a big downdraft in February, another big downdraft in March, and then markets have been extremely volatile in October and continues in November. So I think rather than the trade issues, I think it's this gradual but certain withdrawal of liquidity that is what's behind these volatile markets.
Great. So, like another question one of our viewers gave us is that given that the interest rates are still low, what would be the alternatives to a monetary policy in case of a recession?
Well, that's a good question. But since I don't think either a global or a U.S. recession is very likely over the next year or two, I'm not terribly worried about monetary policy there. Actually, what worries me a little bit more is that the Fed may end up being too aggressive and choke off the recovery and eventually, or choke off the expansion and eventually bring on a recession. What's the old line that there's let's see there. Anyway, the Fed has there's been no here we go. Sorry, there's been no recession that has died of old age. The Fed has killed every one of them. So if the Fed gets too aggressive between now and the end, then they could do the same thing as they have many times in the past. And particularly with the hawkish comments of San Francisco new President Mary Daly, and with what Fed Chairman Powell mentioned a couple, 3 weeks ago, they do seem to tend to be a little hawkish. However, Vice Chairman Clarida, I think it was last week, tried to soften that view. So I really think the Fed is going to pause after a couple of more rate hikes, particularly if we do have a downdraft in stocks next year. But the real problem is that long-term interest rates are still lower than where they're going to be 2 or 3 years from now. You see, the U.S. right now is growing at 5 to 5.5%. That's before inflation has taken off. And over a long period of time, that long-term growth and long-term interest rates tend to average about the same. That suggests that long-term Treasury yields ought to be in the, say, 4.5% range right now. I don't think they'll get there for a couple of years, but nevertheless, interest rates, it's a lot easier to go up than to go down over the next couple of years.
Great. So another user wanted to know, like considering the global market, do you see any risks out of the EU, especially, Brexit or Italy or anything like that?
Well, certainly there are political risks in Europe, and they have to do with the same thing that's happened in the United States. Globalization over a long period of time has brought hundreds of millions of low-wage, underemployed workers into the global economy. And that has put pressure on wages in the middle class. In fact, it's a lot of people believe in the U.S. that the average earnings have essentially been flat for 20 or 25 years. I happen to think that's going to change, and that strong wage growth in the U.S. and in Europe and probably in Japan is going to come back. So that's going to help what happens in Europe. But the two key problems, so it's this populist movement in Europe, in the U.S., in the U.K. that has led to these political instabilities. As ordinary people get kind of angry because their real income has not been rising much, or they begin to be worried about whether their children can have the same standard of living they did or even higher. When they get worried about that, then they vote for a change. That happened in the US, it happened in the UK, it happened in Italy, it happened in Germany. It's the alternative for Deutschland that is causing Angela Merkel some real trouble. But the two key real issues right now are in Italy and the UK for the European Union. I do think that the Brussels and their negotiations with the new government in Italy will ultimately accede to the new government's request for 2.4% of GDP deficit for next year. So I think that's the problems with Italy will calm down. Because I think the EU just needs to loosen up a little bit, and I think they will. Now, it looks like the UK and the EU are not too far from an agreement on Brexit. Whether that will be, how good or bad that will be for the UK, I'm not sure, but at least an agreement of some sort would be good. And frankly, I think sterling, if you want to buy currencies, I think sterling might be a good place to start. So while there's political uncertainty there, I don't think it's going to morph into something really, really unstable.
Great. Thanks for your views on that. So, do you think the RBI will follow the Fed in hiking rates, like we
No.
always do? No. Okay.
No, I do not. I think there's no particular reason for the Reserve Bank here in India to raise rates. People thought they were going to at their last meeting. Didn't happen. Inflation is not a problem with oil prices coming down. That's helpful. Food prices are another source of inflation here. But, your last monsoon, while it was spotty, was really pretty good. So I don't think food prices are going to be a big source of inflation in India. So, and if the dollar is, as I said earlier, I think the dollar is probably going to peak somewhat after the first of the year and start to weaken, not weaken a lot, but weaken some, even as the Fed raises interest rates. I don't see any particular reason for the Reserve Bank to follow the Fed and raise interest rates. It's one of the few emerging market central banks that has not raised interest rates in response to the weakening currency, and I'm not sure it has to.
Great, thanks. I don't want to bother you with too many questions, but I have a couple more. So another question is, has the recent default of ILNFS and the subsequent liquidity crunch in the Indian debt markets impacted foreign liquidity, fund flow into India? What's the sense you're getting about this whole thing about ILNFS?
I think it has somewhat, but I would have to say that the fund flows into India that have slowed down. I think there have been more outflows than inflows over the last several months, or maybe several months. I think that is more due to contagion, feelings of contagion around emerging markets when we first started having those volatility problems several months ago. So I think India was simply a victim of what was going on in the broader emerging markets. From here on, I think it's quite possible that India may be a little bit of a shining light compared to emerging markets, because your growth is better. You're not so tied to China. imports from China as China's growth slows, as other emerging markets are tied that way, and oil prices down. So I think India may be in a little better shape. Now, with respect to the particular default of ILFS, I really think the problem there, of course, was one of liquidity and not solvency. It's the old problem of borrowing short and lending long. I do think that particular company is kind of one of a kind and doesn't necessarily say there's some systemic problem within India, sorry. And furthermore, the Reserve Bank has tightened up the capital requirements of non-bank or non-bank financial companies. So, I think things are in better shape maybe than some of the bad headlines suggest.
All right. So there's one last question I want to leave you with, and I think that's gonna going into the new year, and just most of our audience wants to know what are the biggest risks and opportunities for them in the next year.
Well, the biggest risk, I think, overall, the biggest global risk is the confrontation between the United States and China. China, as I'd mentioned earlier, has not been a particularly fair trading partner for a long time. It's also clearly even though it's denied this, it has clearly militarized the South China Sea. With 3 atolls, putting airports there and missiles and fighter planes and bombers. And it clearly wants a complete dominion over at least Asia. And its Road and Belt Initiative looks like a way to kind of buy access into other countries. China has made some distinct improvements. They've opened up their markets. And we certainly like that, and so long as they play fair, I think that is very important. But I think the confrontation long term, if it does continue between the U.S. and China, is one of the biggest risks. In terms of opportunities, I think India it's really been on my radar as one of my favorite emerging markets for some time. You have tremendous demographics. Your central bank has recapitalized the banking system. So your growth here is you're the fastest growing country in the world. So I think there are a lot of opportunities, frankly, right here within India.
Great, great. Thanks so much, Bob. On that note, we would like to end this webinar. And, thanks for your time. It was really a pleasure listening in.
Thank you very much. I've enjoyed the opportunity.
Great. Have a nice day, and thanks for your time once again.
Thank you.